Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thanks to those who have subscribed to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, it's not rocket science. In my opinion, it boils down to keeping it as simple as possible, consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend, companies with a high return on their invested capital, specifically dividend growth investing. That's what we cover here on this channel. If you are into that sort of content, if you are a dividend growth investor, go ahead and join the Vested Interest community, trying to build a like-minded community of dividend growth investors so we can share our experiences, share the stocks that we're currently having success with, ones that we may not be having success with, stocks we're watching, stocks we're avoiding altogether, just sharing our experiences overall so we can help each other out. You can learn from other people's mistakes, mine included. That's why I started this channel. I was not, born into a wealthy family. I did not grow up around people who had a lot of money or invested, so I'm learning this as I go, and I want to share my mistakes and successes with you, so hopefully you can learn from my mistakes and possibly learn from my successes as well. And that is what this video is all about. Currently, I am doing what they call the options wheel strategy. So I wanted to talk about that a little bit. It is a way to generate some passive income. Well, it's not really passive. There is some work that goes into it. We will be talking about selling covered calls and selling cash secured puts to make income and collect the options premium from selling those covered calls and selling those cash secured puts. Again, it is called the options wheel strategy. Let's jump into the video. And again, if you have not joined the Vested Interest community, go ahead and hit that subscribe button down below. It really does help out a small YouTube channel like myself. Hit the subscribe, hit the notification bell, like the video if you find value at any time, share with anyone you think that might find value in the video. All those things help me out. They help out with the YouTube algorithm to share this video and get the word out so that we can all, again, help each other out along the way to our journeys to financial freedom. So let's jump in, talk about the options wheel strategy a little bit. So, let's start off with what is the options wheel strategy? The options wheel strategy is a technique of selling put and call options on a single stock or ETF to generate income from the premiums and potentially own the underlying asset. The strategy involves completing a cycle of selling cash secured puts, buying the stock if assigned, and selling covered calls until the stock is called away or the position is closed. The strategy aims to profit from 4 different ways: collecting option premiums, buying low, selling high, and earning dividends. The strategy is considered an improved version of the traditional buy and hold strategy, as it allows for consistent investment in high quality stocks or index funds, ETFs, and additional premium collection. The strategy is also known as combining cash secured puts and covered calls. This is a synopsis of all these different sources here. So if you wanted to learn more about them, go ahead and check out optionalpha.com, investluck.com, thewheelstrategy.com, brokerviews.com, or top1insights.com. This is where this information was pulled from. Again, it's a collaboration of all those different sites. Now, since we mentioned a cash secured put and covered calls, we probably need to know a little bit about those two as well. So a cash secured put option is an income option strategy that involves writing a put option on a stock or ETF and simultaneously putting aside the capital to buy the stock. If you are assigned, in simple terms, it is when you write a contract where you promise to purchase 100 shares. So that's important to note. You can only do covered calls and cash secured puts on 100 shares, right? That's one contract equals 100 shares of a stock in exchange for being paid the premium. The premium is the amount you're paid for selling that covered call or selling that cash secured put. This strategy is used to generate income, hedge portfolios, and even speculate on stock prices. The cash secured put is an option selling strategy deployed with the aim to buy the stock below the current market price. Here, an investor keeps sufficient funds to buy the stock at the predetermined strike price. The strike price is just the date when you want to close or the contract will close. Strike price while simultaneously selling the put option of that strike price. I hope this helps. Let me know if you have any other questions. Again, this is a collaboration of all these sources. So NASDAQ.com, OptionAlpha.com, Upstocks.com, Fidelity.com, and Schwab.com. Now you need to know what a covered call is. A covered call is a popular option strategy used to generate income for investors who think stock prices are unlikely to rise much further in the near term. It involves a seller offering buyers a call option at a set price, an expiration date, and a security that the seller owns. So again, you need to own at least 100 shares to be able to do a covered call. So you have to, let's say you want to do a covered call on SCHD. You need to own at least 100 shares of SCHD, and then you can set up one contract. Now, for every 100 shares you own, let's say you own 200 shares, you could do 2 contracts, 300 shares, 3 contracts, so on and so forth. The term covered calls refers to a financial transaction in which the investor selling call options owns an equivalent amount of the underlying security. To execute this, an investor who holds a long position in an asset then writes sells, and we are talking about the sells. I don't buy covered calls or buy puts. So I am talking just about selling covered calls and selling cash secured puts. Call option on the same asset to generate income and income stream. I hope this helps. Let me know if you have any other questions. Again, Investopedia.com. It's just, I don't know why they listed it twice. They just pulled this from Investopedia.com. So if you wanted to check that out, go ahead and look more information on covered calls. So that's a quick high-level overview of cash secured puts and covered calls. Now, this is a good representation of the process I have been using for most of the month of May on WSM, Williams-Sonoma, and we'll see that here in a minute. I'll walk through what I've been doing, but this is a good picture of how it works, right? So I started out selling puts, so that meant I had enough money to buy 100 shares of Williams-Sonoma, so I had to set that money aside, right? And then I sold a put option, right? So then I would collect that premium, the amount that someone was willing to pay me to buy their shares at the set price at a set expiration date. Then if it gets assigned, you get the 100 shares, right? Then you own the underlying asset. So I owned Williams-Sonoma, right? And then once you own it, you can turn around and sell a covered call on it because you own 100 shares, and then you can collect premium then, right? And then if it's assigned, but what basically means when it hits that date, if it's above the strike price, you sell the calls, right? And then if it's assigned, the stocks go away. So someone has bought your 100 shares. If you sold it for more than what you purchased it for, you collect the profit, plus you've already collected the premium, and then you restart the process. So now you've got that cash again. Now you can sell a put, right? And then you just keep that wheel strategy going, right? You can almost think of it as a triangle too, right? So I've got cash sitting on the side. I can sell, I want to own a particular stock. I'll sell a put option on it. I'll collect that premium. Then if it's assigned, that means I buy the 100 shares. Then I can write a covered call on it. I collect the premium there. If it gets called away, that means it's assigned. It hits the strike price. They get my 100 shares, but I get the money back, plus I keep the premium, and then I can restart the process over and over again. So that's a good representation right there of exactly the wheel options strategy. Now, as I stated, I have been running the wheel on Williams-Sonoma for the last month. So I'm going to walk through this, what I've done since May 3rd. So on May 3rd, I sold to open a cash secured put. So again, I had $11,400. That's what I had to set aside to buy 100 shares of Williams-Sonoma. I said on May 12th, that's the date that the contract expires, the expiration date of the contract. So on May 12th, if it would have been $114 per share or more, so even if it's above that, I buy at $114, right? So I pay $114 for the put, or they pay me, and I say I'm willing to buy it at $114. They paid me $179.45. This is the options premium. So regardless of what happens, if I'm not assigned these shares, I keep that $179. If I'm not assigned the shares, I keep the $11,400 that I would have had to set aside plus the $179, and then I could write another cash secured put if I wanted. But in this case, on May 12th, which was the expiration date of the contract, it was $114. I think it was actually a little bit above $114, or I'm sorry, below $114. So even if it's below $114, I'm willing to buy it at $114. So I was assigned these shares. That means I bought the 100 shares at $114. So that $11,400 just purchased the 100 shares that I wanted. So now that I owned 100 shares on May 12th, I turned right around and sold to open a covered call with a expiration date of May 19th. That was the next Friday. So these all expire on Friday. I'm doing weekly covered calls or weekly put options here. Same stock, Williams-Sonoma. Expiration date May 19th. And I said, I am willing to sell those same shares, 100 shares at $114, right? Same price even. I didn't even go up in any. For that, I received $239.45. So someone was willing to pay me $239.45 for the option to buy 100 shares of Williams-Sonoma at $114. Now on May 19th, it was actually $114 and some change. I think it was 73 cents, 114.73. So I lose out the $73, but I keep, right, the 73 cents times 100 would be $73. So I don't get to sell it at 114.73. I had to sell it at 114. So that's the only downside. You don't get that additional, but you still keep the premium. So I actually made out on that. Even though it was 114.73, I sold it at 114, but I kept the 235. So if you take off $75, that's the amount I made, right? Because that 75 or $73, whatever it was, would have been potentially, if I just sold it outright, I could have collected that $73 or $75. But in this case, I made more because I got $239.45 in premium. So again, started with a cash secured put, was assigned to the 100 shares, wrote a covered call, then that was called away. So then someone bought my 100 shares on May 19th because it was above the strike price of $114. And then what I did here is I went right back to the wheel and sold to open another cash secured put, right? So my shares were called away. I had the funds again. But on this one, I went lower. Now I want to buy those shares at $112. I believe Williams-Sonoma is dropping in price. So I want to buy this lower than the 114 that I originally bought it for up here. So this is a way to make premium while I'm trying to buy the underlying security, Williams-Sonoma, in this case, 100 shares here, at a lower strike price of $112. For that, I collected $389.45. Now, the strike price, it doesn't show up in my account yet, but by the end of the day today or first thing Monday morning, I will get this $11,200 back in my account in cash because Williams-Sonoma on May 26th, which was Friday, closed the day out at $113 and some change. So I did not get assigned these shares, right? I did not purchase these. So I still have the cash. So I'm going to write another cash secured put on Monday and collect more premium. What that premium is, I don't know. I haven't looked yet, right? But I'll update this and probably go over this maybe next month so we can see how it tracks over a month. I collected total with this original on May 3rd, cash secured put, $179.45. This call, covered call on the 15th of $239.45. And then on the 22nd, another cash secured put, $389.45. All total so far for the month of May, I have made $808.35 in premium, right? This is the amount of money I have made for trying to buy Williams and Sonoma at $112 to $114. This is over twice what I would make in dividends if I was to just buy Williams Sonoma and hold it for a year. It's a little over $300. Williams Sonoma right now is above 3% dividend yield, so it'd be under $300 on 100 shares. So if you multiplied that by 2 years, that's around $600. So if I just bought Williams and Sonoma and held it for 2 years, I would make less in dividends than I have made in options premium. So this is a very good way to collect cash for trying to own a good company, right? Now, I am not an expert on this, but this is just what I've done so far with this. I have written covered calls and cash secured puts on a couple other options, but this one in particular, I'm going to continue to run this wheel option on and collect the premium for selling these covered calls and cash secured puts. And I am putting this money right back into my portfolio into other positions. Actually, I have bought 2 shares of Williams Sonoma out of this premium. So I am buying this underlying stock with the premium plus adding it to my portfolio in other positions that are down. It is a very nice way to generate income. If you own 100 shares, I'm not saying you should do this, but it is an option. And I wanted to bring it to you because for me, it has been very profitable so far. Now I thought I'd throw this back in again. Maybe this makes a little more sense now. Again, if you have some cash sitting on the side, you want to buy some stocks, and you have enough to cover 100 shares, an option for you to do would be to sell a covered put, or I'm sorry, a cash secured put, collect the premium. If assigned, you can sell calls, you collect that premium. If that gets called away and someone takes your 100 shares, you get the money back. You keep the profit if if you bought it. If you sold the call for, let's say you sell a put for $114 on Williams Sonoma, for example, then you sell a call for $116, you would get that profit plus the premium. That's a way to do it too. And then once you sell it, stocks get called away, you restart it, and you can continue that wheel strategy as a way to kind of juice up the amount of inflow of cash into your portfolio. But again, you have to have either start with 100 shares, or you have to start with the cash to do a cash secured put, or have the 100 shares to do a covered call, right? Well, I hope that made sense. Let me know down in the comments section below what you think. Do you use the wheel strategy? Is it one you've heard of before? Do you use options, or are you just a buy and hold long term and want to stay away from options altogether? I know it's not for everyone, but it is an option. Wanted to bring it to you and show you what I've been doing the last month with Williams Sonoma to generate a significant amount of income from the portfolio without actually really holding the stock long term. And I haven't collected any dividends. Now on this one in particular, what I'll probably do around the dividend time, what I'm thinking is probably a couple weeks before, I'll try to actually just buy it and hold it through the ex-dividend date, and then I'll start the wheel back up, and I will continue that process. I'm going to try to continue it for the next year just to see how it works out, and I'm going to continue to use Williams Sonoma. It seems to be giving me the best premium options right now. So I'm going to continue that one as long as it does. And I feel like this one, or I think this one, is going to continue to drop in price. So it is a way for me to get the underlying stock at a lower price than what it currently is. So I'm trying to get it under 110. So again, I'll probably go back in and do a cash secured put for $111 or $112, see what that gets me in premium, and try to continue to buy it lower, sell it for around what I bought it for, and then buy another, sell another cash secured put and buy it lower again. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Let me know what you think of the video. I do personally read and respond to the comments. I'm always interested to read your questions and or opinions. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, hope you have a great weekend. Happy Memorial Day. Don't forget to tune back in tomorrow. On Sunday, I'll do my portfolio update. You will get to see everything that I have done in my portfolio this week, any buys I made. I will cover, the Williams Sonoma cash secured put again that I did this week, so that you can see that and see how the options premium is helping juice up my portfolio. Hopefully you got something out of this video. Let me know what you think down below. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and abundance. Should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.